Give me 2 more. Whether the screen is visible?
Yes, sir.
Okay. So let's talk about capital gain. The chapter capital gain is talk about purchase or sale, which we are doing of capital assets. So in this chapter, what we're supposed to learn is to understand what is the capital gain, what is meant by transfer, what is meant by short-term capital gain, what is meant by long-term capital gain, and how it is valued. So till date, we have learned about income from business and profession, income as salary, residential status, and the next part we are learning is income from capital gain. Now, let's begin. What is capital asset? As per definition of finance, a capital asset is long-term investment. Either it is a purchase or hired, having large amount and giving the returns over more period. So please remember, when I say capital asset, I'm talking about a large sum of money, higher period, and generating returns more than one accounting period. So whatever we invest is known as capital investment. Now, duration of capital asset will change based on type of capital asset. For example, a share, if I hold more than one financial year, it is a long term. If I have gems and jewelries, if I have bonds, if I have debentures, if I have physical assets, if I have furniture, every asset has different period. So logic of applying to call short term and long term will apply. When I buy and sell any capital assets, if I get any advantage, then the difference between buying and selling price, if it is a positive, I am generating profit, then that is taxable as a capital gain. For example, if I purchase a building of 10,000 and sell the building at 26,000, so 2,000 is my gain. So when I have 2,000 gain, in that case, this 2,000 will be taxable. Now, there are some provisions where the tax liability is reduced, or I can get the concession for taxation. There are some investments, there are some means and ways, but how and what we need to discuss under capital gain. So basically, transfer of assets which are of capital nature, if they generate any revenue, that revenue is again taxed as a capital gain. And in this chapter, we are going to study the types of assets, types of transfer, and computation of capital gain. So let's start. There is a difference between sale and transfer. Now, what is transfer? A transfer means sale of capital asset and where ownership is changed from one identity to second, or it will change its type of possession from one person to other. Now, please remember, when I'm saying transfer, it is only passing the ownership. If I say sale, it required consideration. If merely I just give something, suppose I'm happy, I don't give my house to my ex-friend, then if he did not give me anything return, then it is recognized as gift. But here, in case of gift, I need to make clarify that capital assets after certain limits cannot be gifted. So to call sale of asset, the first thing I required something as a money consideration. Second thing I required transfer of ownership. And third, when I transfer the asset, it should have some marketable or realizable value. For example, I hand over a dustbin to my friend and I call it capital asset. Dustbin can be asset, but when I give it to my friend, the value of dustbin will not remain same. And to recognize anything as a capital asset, I need to first prove that it is going to generate a revenue. So, what is nature of assets, actual transfer, and financial deals about that asset is particularly important to call whether transfer, sale, or just gift. Now, how they decide? The first, we need to find out the price of that particular asset. Second, we need to find out source how the finance is done. Then, after finance, we need to find out the purpose of selling or purchase of asset. And based on that, we have to follow a logic. For example, first find out amount which you received or paid for capital assets. Then try to link and find out whether this capital asset is purchased out of your previous investment or it's a new purchase. Most of the time, when I purchase the capital assets, I'm not required to pay any taxation. But when I'm going to sell this asset, I'm definitely going to pay the tax part. Secondly, as I said, find out whether this is a gift or zero sales value. Because sometimes to cheat the law, what people do, instead of charging any amount, they said it is a freely given, so zero value, no capital gain. But whenever the person is selling, and even though it's a gift, similar assets are valued, and based on value of similar assets, the price of that goods are charged. In case the person who is owning the assets, he dies, in that only case, if the successor follows into step of original buyer at the occurrence of death, natural calamities, or emergency, that case he is not liable for capital assets. But when in natural circumstances assets are transferred, either paid something or free, whatever the gains to the seller or whatever the loss to the seller, both are accountable for capital gains. Now, loss means it is a negative calculation, you're not required to pay. But for accounting purpose, they always calculate capital gain. So if negative gain is there, it is loss, and you can claim the deduction for subsequent 4 years against your profit from next assessment year. Then, when I'm doing a capital asset, there are two adjustments are given. One, it's improvement. It can be renovation. It can be maintenance or anything. So if I have maintenance and I have improvement in particular asset, then depend on the relevancy, depend on nature of cost and documentation, I can get a discount before calculating value of capital gain. For example, if I have constructed first floor of building and when I was selling, my house was 3 floor. So when I buy the house, it was the first floor. Then what about 2 floors? I need to do valuation based on their occurrence. So I will do all this calculation part. Then, as we all know, that most of the capital assets like building, furniture, etc., they are liable for depreciation. So depreciation is also allowed as adjustment before calculating the capital value. So basically, if I summarize, in case of capitalization, I'm being allowed to first understand what is the capital. Based on capital, I need to understand what is sale, what is transfer, what is value of transfer, and then I can decide whether gain or loss is there, and what is the gain or loss. Then I have to go for the calculation of capital gain. Now, any doubt till this? Okay. Now let's talk about short term and long term. Now, basically, why you required to understand this short term and long term? Because if I'm selling a property which is purchased by my grandfather's grandfather, okay, in this case, the value of asset is very negligible, but value of gain is very high. For example, when my grandfather's grandfather purchased a property in Mumbai, that time the cost of that property was 2 rupees. Now we already know time value of money. So 2 rupees property now I'm selling at 2000 crores. Then my capital gain will be huge. If my gain is huge, I'm going to tax for the same. But this is not proper because when the asset is purchased at 2 rupees, the value of 2 rupees was different. And when the asset is sold at 2000 crore, the value of 2000 is different. So for that, I need to find out index calculations. We have two times index calculations. One is 1980 and second index is in 2000. Now just they are planning to revise, but I'm not confirm about the latest. So based on index pricing, I can find out appropriate value of long-term capital. In case of short term, if asset is owned for a period of 12 months or less than 12 months, it is considered short term. And if it is more than 1 year, it is considered long term. Short term will have less tax liability and it will have less deductions. Whereas long term capital gains are normally have larger amount, so they have more exemptions compared to the short term capital gain. So as I said, long term capital gain has preferential rates 0, 15, and 20, whereas short term has up to 37. And in short term capital gain, normally no advantage or no tax concession or benefits are provided. All tax concessions are mostly given for long term holdings. Now, when I say holdings, it means a period from purchase and sale. For example, if I purchase in 2000 and selling in 2023, the 2023 minus 2000, the period which I get is of 23 years. So this 23 years period will be considered the long term because we are state the definition. Before 12 months, it's a short term. More than 12 months, it's a long term. Now, short term capital gains are taxed as normal. Its minimum value of taxation is 10% and the maximum value is 37%. When your income is up to 11,600 or if combined together with your partners, if married, 23,200, then your capital gain percentage is 10%. Whereas if your income as a single earner is up to 50,000, the rate goes 22%. And if your income is more than 6,09,350 or jointly as 7,31,200, that is taxable income, then in that case, you are charged at 37%. So please remember, short-term capital gain rates are depend on level of income which you are earning. Up to 11,600 single or 23,200 jointly is 10%. More than 50,000, it is 22, and more than 6 lakh 9,350 for a single. And if married, 7 lakh 31,200, it is 37%. Now, what about long run? In case of long term, it has preferential tax rates. Now, what is my preferential? Preferentials means based on your level of income. So, if your gain increases, your percentage of tax will be increasing. Lower the gain, lower the tax. Higher the gain, higher the tax. For example, 0% is up to 48,350 for single, and for joint 96,700 it is zero. Zero means no capital gain will be applied. For assets which are gain up to 4,92,300 as a single, and jointly up to 5,53,850, it is 15%. And over 5 lakhs, it's 20%, whereas it is 5,53,850 for jointly. So we find out for up to 50,000, earlier, if it is short term, up to 11,000, it is 10%, up to 50,000, it is 20, and more than 6 lakhs, and so it was 37%. So if I compare the 15% up to 5 lakhs, and here the short term gains are more charged, because even the more than 5 lakhs, my tax rate is not 37%, it is 20%. So always valuation, whether it's a basic or advanced, I need to consider whether it's a short or long term. Then if I justify it's a long run, then my tax liability will go down. But if I'm failed to justify long run, then I will not able to take benefit of preferential tax rate, and my tax liability as a capital gain will increase. There are some special cases. The first is art, coin, and stamps. So if I do some collection of art, coin, stamp, they are at 28%. If I'm doing some small business of stocks, 28%. And if I am under real estate, then it can be 25%. Plus 3.8 of investment of income for higher earners. So along with this is a additional provision for high income. So those who are history lovers and having collections, or the real estate persons who are holding for longer run, they have different rates. These rates also increase by 3.8% if the level of income increases. If I just try to see the capital gain, it is continuously increasing. Why? Because when initially lower gains, it perpetually increases when the duration and amount goes on increasing. And that's why the rates are always seen going high and high. Now, what are steps how I can decide what is the capital gain or loss? The first step is to find out the purchase price. When I say purchase price, it normally allowed to charge the commission. It is allowed to charge any additional tax I need to pay, any installation I need to pay, any license I need to pay. So purchase price plus commission plus taxation plus improvements, or plus any installation charges, or plus any other charges, then these all charges are liable to pay as part of my total value. For example, I purchased a machinery of 2 lakh rupees. For transporting machinery from supplier to my place, I require 1,000. So 2,000 plus 1,000, I'm getting machinery of 3,000. For foundation of machinery to work, I need to have 1,000. So again, 2000 plus 1000 plus 1000. My cost will become 4000. And if any tax or any charge I have paid additionally, that also added to the value of that machine. So here, what is important is to consider for any asset my basis of charge. It is a price plus commission plus fee plus improvement. And this formula is used to calculate adjusted amount. So as per accounting policy, we first find out what is the cost. Second step, we have to find out what is the gain after selling it. So how we find? For example, my cost of purchase is 5 rupees and cost of sale is 10 rupees. Then what I'll do, 10 rupees minus selling fee, if any, because when I'm paying the commission for purchase, I may also pay commission for selling. Suppose commission for selling is 2 minus its price, so gain will be 3. So while purchase price or sales price, I can adjust commission and selling fees. Once I get purchase value, I get sales value, then I need to find out difference between purchase and sales, and that is called as a net proceeds. Once I calculate purchase or sales, for example, here I calculated 3. Then I have to find out whether it's short or long. And based on period, I have to apply the taxation rates. Is it visible or shall I increase the? Okay. This is an hypothetical example which I taken. I bought 100 shares at 50 rupees each and rupees. So my total price of shares will be 50 into 100. It will be 5,000. If I paid 10 rupees commission, then total basic price of purchase is 5,010. I hold these shares for 8 months. Now, if it is less than 1 year, it is called as a short. If it is more than 1 year, it is called as a long. So I purchase shares of 5,000 with commission. If my commission is 10 rupees, then total price of share is 5,010, where I have paid commission, this the commission will be added. In this case, I'm holding the asset for 8 months. So it's a short term. Now, when I'm selling the assets, I sell it at 60 rupees each and paid 10 rupees commission. So 60 into 100, I'm getting 6,000. But since I'm paying commission, this is out of my income. So when I have 6,000 income, I'm not getting 6,000. The 10 rupees are deducted. So what I received is 5,990. Any doubt in this? So if I want to calculate again, I purchase at 5,010. Now when I'm purchasing the assets, I need to add the details in price. Why? Because I'm paying that amount and additionally commission is paid, then I need to add the commission. But when I'm selling the things, I'm receiving the amount. So the person who is giving amount, he will always minus his part. That's why it is gain 5,010 as an income I spent for purchase, and after selling, I received 5,990. So what is the extra I'm receiving is 980, and this is my capital gain. I hope this is visible. Any doubt in this calculation part? This is a simple numerical. Let's move further. How to make netting capital gains and losses. The first step, group all the short-term transactions together and also group all the long-term transactions together. When you're saying short-term and long-term, please find out the reason, because whenever you're filing a return of capital gain, it is assessing responsibility to declare and claim and support the documentation to make it short term or long term. Now, suppose if I make a profit in short term and if I make a loss in long term, I can compensate to each other. So, what I mean, netting means I'm combining here two things, short plus long, and then I have to find out what is my capital gain. If suppose in short run I'm making profit, and in long run, if I'm making a loss, for example, my loss is minus 10, and in previous case, my gain is 5. So ultimately, my answer will be minus 5, and I am not required to pay any capital gain. And this is nothing but the net. So first, I will find out short-term transaction and long-term transactions. Second, I will combine all short-term and all long-terms. It can be profit and loss of each transaction, but I will combine. After combining, I will find out what is difference or what is the report I'm getting. If both are losses or one is showing gain and other is showing profit, I need to find out by this method. And after applying rule, whatever the difference, I can pay the tax for the same. So, what is netting effect means? Netting effect means the short term and long term if I capital assets, and if I'm getting a gain out of the same, then in such case, I need that I should able to adjust long-term and short-term capital gain so that my tax liability may get reduced. Any doubt in understanding netting effect? What is netting effect and how it is given? I hope no doubt. So let me proceed. Now, as per Indian accounting standards, we need to report short-term and long-term. So this is not so important for our syllabus because reporting is not our importance. Our importance is recognizing short term and long term and then do the valuation. Now, if these are special cases, if donor is given some assets, then holding period will be also include donor as capital valuation. For example, if I have donated suppose X product to somebody, but in transit, suppose 5 weeks it takes to reach the particular person, then that transit period is also called as a purchase duration. It is not exempted. Similarly, we need to also understand how the holding is done. If the holding is improper, what I mean to say improper, if the holding is by multiple agents and purposefully delayed, then in such case also we need to analyze for different abilities and different calculation because strictly we are not able to analyze or calculate the same if we're not able to calculate the holding period. Because sometimes to cheat the law, I'll not deliver the goods. I'll keep it holding with one agent, second agent, three agent, four agents. So on. So even though agents are holding, it is considered as transition period and part of capital gain. Second, if the sale is in partial or in installments, even that it is taxed from the day one shipment. Suppose I'm supplying a boiler part, then the first installment of boiler till the last installment, I can claim that till the last part I received, I cannot say it was a complete boiler. But when you initiate the transaction, it is our convenience and comfort to send in parts. It is not mandatory as per tax. So when the first part is shipped or when the actual ownership transfer, the competition of short term or long term is started. If I received any gift or a product and I am not paid any amount, then how to calculate gain or loss? In case suppose there is person who has died, but I don't know what is his property value. Then on the date when I receive the product, I need to find out suitable appropriate market value and appropriate market value will be considered at its purchase price. In case of collectibles like art, antiques, coins, metals, stamps, they are flat maximum charge at 28%. So these are some special competition purposes. Now, when we are scheduling the planning, we are scheduling the movement, we need to also take in consideration the how we can minimize impact of capital gain taxation on our tax liability. The first thing what we need to do is instead of short-term holding, we need to have long-term holdings. So instead of short-term holdings, we should have long-term holdings because the tax percentage are less. Second, instead of underperforming investment, we have to offset and try to use netting effect to avoid maximum tax burden. We should plan our capital gain advantages in such a way that maximum tax liability is reduced either by way of netting or by way of some tax concessions available under long run and for short runs. So, what are some common misconception? All assets are capital assets. No, all assets cannot be said as a capital assets. There are certain list of assets which are mentioned under capital gain, and that are only capital assets. Inventory, copyrights, patents, business supplies, or accessories along with the main product are not capital assets. So please remember, if exception to the capital gain, then if your product is not part of a core product, they are as accessories or they are business supplies as a core supplies, then they are not capital assets. In case I sell the capital assets, I need to pay capital gain. So normally, when you enter into a contract, you receive the contract that this payment is due to you. And suppose you received payment less. So when you receive the gain, actually, you need to pay the capital gain. It is not like accounting that I booked in this year, but if I receive the payment next year, then I should able to pay the gain next year only. So realization is important. Received or receivable concept here it is not applied. For this, only realization is more important. In case if any asset is not used for business but for a personal property, then that type of capital assets are not allowed to recognize as capital gain or loss. So that asset should be completely used for commercial purpose. If that is used for personal purpose, they are not allowed to get the benefits of capital gains. Now, in many cases, if one investment is exchanged with other investment and there is no gain, then there is no tax liability. But reinvestment of capital gain is invite capital liability if it's a short term. But if long term investment of capital gain, then I can claim exemptions. So to summarize, what is a capital gain? Capital gain is the income which is generated from sale of capital assets or transfer of ownership of capital assets from one to other when excess of sales consideration or excess of sales price or purchase value, it is considered as capital gain. Now, when I say capital gain, it is always classified as short run and as long run. When it's short term capital gain, its basic charge is 10% and highest charge is 37%. The capital gain charge is depend on level of income in case of short run, whereas in long run, it mostly depend on the type of assets and level of income both. I can claim the netting effect while I charge it, that is combination of various short run and long run gains or losses as per the situation. For all this capital gain justification, I need to have a proof or answer what is capital gain, whether it's a long run or short run. The liability to declare the short run or long run lies with the person who's filing the return. It is not income tax authority's responsibility to check whether it's short run or long run. So finally, if I'm a very strategic planner, I should plan my assets and final their efficiency. So if the efficiency and the valuation of assets I'm not particular, then in that case, I'm losing on count of capital gain. And so when I talk about capital gain, I always decide first to understand the capital asset, second to understand the short run, long run, then how the valuation is done, and based on this valuation, what I can do is I can just analyze short run or long run. So any doubt till now? So let me revise again this by one of the other PPT I'm having. Capital gain or capital loss are the two factors we have studied under capital gain. If my sales price is more than my purchase price, I'm getting capital gain. Where my sales price is less than my cap purchase price, then it is a capital loss. In case my capital gain, I'm liable to pay the tax. But in case I have a capital loss, I can offset this loss over a particular 4 years. Now, if you do remember, in a balance sheet, we have something called as accumulated loss. This accumulated loss is nothing but my capital loss, and I can claim as my asset for 4 years in equal installments or for 1 year against my profit, and I can get a tax deduction. Secondly, any personal property which is used for personal purpose, it is not allowed as capital assets. Any investment that are stock, bonds, mutual funds, cryptocurrency are used for investment purpose, they are capital assets. For real estate, land, property, plots, building, they are considered as a capital assets. So this point we discussed already. Okay. So let's revise again. A short-term capital gain 1 year or before, long-term capital gain more than 1 year. Now, this will discuss what is sale, what is exchange, what is gift, and inheritance. So just read it. If any doubt, let me know. Then what is transfer of asset? Please just read, go through this. I'm just revising the topic. Let's go further. So this is overall for today. I'm closing today a little early because I want capital gain calculation part to be covered as a fresh topic. So if any doubt, we can discuss. Otherwise, we'll call off for the day. Anybody has any doubt? Any doubt? Okay, no doubts. Then it's okay. Next lecture, what we are going to learn is how to calculate capital gain. For short-term capital gain, we don't require any big deal. But for long-term capital gain, we have something called as index valuation. So first we have index valuation of purchase, then index valuation of improvements, and then based on these two index values, we have to find out sales. So in tomorrow's session, we'll do the calculation for short run and long run. Apart from this, there are no much contents deserved from this capital gain. There are certain exceptions to the rule of capital gain. So that exceptions also we will complete tomorrow. So this way, we are completing our fourth part. First, we'll talk about basics, then we'll talk about salaries, then we'll talk about income from business and profession, and then we'll talk about capital gain. You already received a mail regarding your CC, so it is suggested that please go through that mail, complete all your semester 2 CCs in time, and make sure that they are followed in particular format. Okay, so for your convenience, I'm just sharing details. Advanced Financial Management CC1 has submission date 25th, second submission date 27th, and the third 24th November. Whereas direct taxation 29th, first submission, again 29th of next month, second, and 26th of November is the last. So you got three subjects: advanced financial management, security analysis portfolio management, direct taxation, financial reporting, and international finance. So please take a note of this and complete your all submissions. Okay. So that's all for today. Please, I'm closing this meeting now. You can join the next meeting. And thank you for being patientful listening to my thoughts. If any doubts, you are suggested to put across in a session as a chat box or a question. Those students whom I am a mentee, please make sure that you're sharing the all screenshot in a group. Thank you. Wish you a wonderful time ahead.